Welcome to Policy Bazaar. I'm Arjun Bhagat. Now, ULIPs or unit-linked insurance plans were once much sought-after financial products in India. However, in 2010, the IRDA capped the annualized charges of ULIPs at 2.25% for the first 10 years of holding. Now, the charges were fixed at this rate as it was the average cost charged by competing products such as mutual funds. Now, with fewer incentives, distributors stopped really pushing these products and ULIP sales witnessed a sharp drop. Now, these investment-cum savings plans have once again changed to become a low-cost investment option for customers. In fact, some of the recently launched ULIPs are much cheaper than mutual fund plans. We have Naveen Kukreja with us, Group CMO Policy Bazaar and Director Policy Bazaar with us in our studio to help us understand how ULIPs work and how to buy them. Welcome to the show, Naveen. Now, ULIPs have had this up and down kind of a journey. They were very popular till 2010, then they went down. Tell us why that popularity was suddenly reduced.
So Arjun, thanks for inviting me. What happened was when the private sector insurers came in and started in 2003 and 2004, they were the ones who started popularizing ULIPs or unit-linked plans. Initially it was for the right reason, because over a long period of time, if the consumers invest in a market-linked product, they're likely to get higher returns. But what happened was that the initial products that were launched had higher charges built in, and there was also issues of mis-selling because the consumers were not aware of what exactly were they buying and for how long. So when consumers started completing 3 or 4 or 5 years of the product, which started happening in 2008 and 9, combined with what happened to the market in 2008, 9, 10, when the markets crashed and the value of investments came down, a lot of customers started cancelling, started complaining to the regulator. So the regulators took notice of that and came out with a regulation in 2010 which capped the charges, like you said. Suddenly what happened was that there was no incentive for the distributors to sell the product, and the consumers also became very wary of the product, which led to the downfall in about 2010 onwards of ULIPs.
So then, what it sounds to me like is that ULIPs are pretty similar to mutual funds, that they invest in the same kind of a product. Charges are now pretty much the same, you're saying. So how do you draw that distinction? What makes ULIPs different from mutual funds?
Very rightly said, Arjun. Like you said, that they are similar but yet different. They're similar in the way they invest in for the consumers' money. They're similar in the long-term horizon, from a long-term horizon perspective. Both mutual funds and any market-linked instruments are long-term instruments, so consumers should look from a long-term perspective. But they're different from the perspective that ULIPs offer you extra added protection cover, which is a life cover that comes along with it. So it's a combination of a mutual fund and term insurance. They're also different in the sense that they are more flexible, in the sense that if you take ULIPs, you can easily switch between a more aggressive investment strategy by investing into equities, or a balanced strategies by taking a balance of equities and debt, or investing in very low risk secure instruments like cash or money market instruments, which are low risk but low yields.
So within that product, so what you're saying is there are a number of subcategories.
Yes.
Okay, so why should an investor buy ULIPs now? I mean, what are those advantages that we have talked about? I mean, can you just reiterate those?
Yeah. So what's happened, Arjun, now is that the new set of ULIPs, and there are 5 or 6 of them now, they are really low cost. In a lot of cases, they are lower cost than mutual funds. So the first advantage that the new ULIPs have is that they are very low cost. Most of the money that the consumers invest goes towards the investment and growth of their investment. There are very few charges, like the fund management charges and policy administration charges, to the tune of around 1.3 to 1.5%. The other reason is that they are now available online, so it's easier for consumers to compare and buy them and kind of manage them. The third reason why they're becoming popular and consumers look at them is that, of course, they remain one of the instruments which help you save tax, both at the time of investment through Section 80C, where you can claim tax exemption up to 1.5 lakhs. Also at the time of redemption, when the money matures and you kind of withdraw the money after a period of time, all of that money is tax-free, which very few instruments offer. So in that sense, ULIPs are becoming more attractive because they're becoming low cost.
So would it be correct to say that ULIPs are now cheaper than mutual funds, and how? I mean, what are some of those points there?
So a couple of things to keep in mind is that when you compare ULIPs and mutual funds, it's difficult to compare all mutual funds with ULIP, because most of the mutual funds do not offer the tax exemption benefit which a ULIP offers. The only mutual funds which offer tax exemption benefit are called ELSS, or tax saving mutual funds. You can see particular mutual fund to know whether they are in that category or not. Typically, if you look at these mutual funds which are ELSS, because they offer tax exemption at the point of investment, they have a higher cost. Their cost typically ranges between 2.5% to 3% of the fund value. So if you have invested 100 rupees and your corpus has become 500 rupees after 3 years, this mutual fund will charge 3% of 500. Whereas the lowest cost ULIPs are now deducting charges to the tune of about 1.4, 1.5%. So they really are much lower in terms of the cost. Plus the other benefit of ULIPs versus mutual funds is that you have flexibility as an investor. So if you're really looking for longer term, which is the reason you should get into ULIPs in the first place, you start with investing into equities and market linked investment, which usually grow at a higher rate than any other instruments over a longer period of time. But towards the last fag end of your investment, so the last 2-3 years, you can convert all the investment to the debt instruments, which are low risk and low yield but low risk instruments. So it's easy to switch from aggressive to a balanced to low risk strategy within ULIPs.
And that's a strategy that one would advise customers to take advantage of.
Yeah, so it's very easy to take advantage of that. It's easy to switch. Mutual funds, if you wanted to switch, you will have to redeem one new mutual fund, enter into another mutual fund. So that will be the disadvantage. However, one should keep in mind that ULIPs are longer term investments. They have.
What would the ideal horizon be?
So my suggestion is that if one is investing into ULIPs, the ideal horizon should be 10 years or around, but definitely over 5 years. Typically, the ULIPs come for a tenure of 5, 10, 15, 20, up to 20 years. For really long-term planning like retirement planning or child education planning, ULIPs work as a good instrument. The other advantage, or in some sense the discipline that ULIPs are able to offer, is that they enable you to force save over a longer period of time. I've spoken to a lot of consumers who, when they invest into mutual funds, they invest from a long-term horizon, but 3 years, 4 years, 5 years into the investment, when the markets look good to them, they redeem all the investments and they end up not reinvesting and spending that. So ULIPs in that sense offer a mechanism wherein you have a forced saving.
So the perspective you're saying has to be different when you're investing in a ULIP and a mutual fund.
Absolutely. Although both are market linked and both should have a certain horizon in mind. So even if you're investing in mutual funds, you should have a longer term horizon in mind. Typically, if you're investing for less than 3 years, I would advise that do not go for mutual funds or ULIPs, because you don't know what will happen in the next 3 years. But historically, you see that any consumers who have a horizon of 5 years or longer, the market linked instruments like ULIPs or mutual funds tend to beat any other instruments which have a fixed rate of return.
So which profile of people does ULIP really benefit, and what age group? Is it the 20s, the 30s? How does that? What advantage is accrue?
So I think the younger you are, the more benefit or the more beneficial ULIPs would be for you, because remember, ULIPs also have a term cover associated.
So they protect the family in case something happens.
But if you're very old, the term cover part of the ULIP will take a lot of charges, because the mortality charges will be higher depending on how old you are. So the younger you are, the better it is to kind of get into a longer term. Also, you have a longer horizon if you're younger, because you can think about retirement, which is 20 years away. You can think about child planning, which is more than 10 years away. That's the ideal age from a ULIP investment.
So before investor actually invests in ULIPs, what are some of the factors that they need to keep in mind?
So I think the right starting point is the reason and the horizon for which you are investing. The horizon, like I said, should be long term. You should have a particular goal in mind when you're investing. So if your goal is retirement, then your horizon gets decided by that. If your goal is child planning, then your horizon gets decided pretty much by that. But if you have a horizon of greater than 5 years, ULIPs are a good instrument. The other thing you should keep in mind with ULIPs is that you have to invest for the tenor that you select. So select the tenor of the product very carefully. If you are looking for a 10-year product, select only a 10-year product. Do not select a 20-year product. And then when you select the product, you have to keep in mind that you have to be very disciplined about the investment. So you have to invest the same amount of money at the desired or agreed frequency, whether it's annual or monthly or quarterly. In that sense, it works great if you in helping you create a corpus by disciplined investment. The other thing you should keep in mind is you look at the features and the charges very carefully of ULIPs. So some of the online ULIPs which are available now have very low charges, but look at their charges, read about the product yourself, look at it, you can compare different products on a comparison site. The other thing you should keep in mind is that for the ULIP to have the tax benefit, the sum assured must be 10 times the premium amount. So take care of that, look at that and ensure that it's 10 times, then you will get all the insurance benefits. So these are some of the things that one should look for.
Right, Naveen, you talked about some of the tax benefits of ULIPs. Can you reiterate that and also give us the main benefits that an individual can get investing in ULIPs from both the short term as well as the long term perspective?
So ULIPs are and insurance in general is an instrument which is very, very attractive from a tax perspective. It saves you tax when you're investing. So ULIPs are part of ATC, which means that you can invest up to 1.5 lakh rupees and get your income exempted from tax up to the tune of that amount. ULIPs also are an instrument which are of the type EEE, which means they are exempt from tax at all stages, which is investment, accumulation of funds and the redemption of funds.
That's a huge advantage. What kind of limits do we have in that?
So at the time of investment, the limit is as per ATC, which is 1.5 lakhs. By the time of growth, there is no limit, and at the time of withdrawal, if you've invested in the same manner, there is no limit. Everything that you get is tax exempt. So that's one reason ULIPs and insurance in general is a very attractive instrument from a consumer perspective.
So clearly, a lot of new packaging has gone into, IRDA has come up with new norms, the cost price has fallen as far as ULIPs are cost to customers, but that apprehension still seems to remain. I mean, if my statistics are right, it used to be quite high, the number of people buying, and we still haven't reached that kind of popularity of ULIPs.
You're absolutely right. So because of what's happened in the past and because of the fact that the products were actually not very good, the consumers are still apprehensive about it, and they're taking time to kind of get back to these products. But what I'd like to tell the consumers who are watching this show, that the new set of ULIPs, read about them. They are very, very good. They compete, like I said, very, very favorably with any other instrument that you have. The only condition is that you should be ready to invest from a long-term perspective. The other thing that's happening is that because of the way insurance distribution is structured, it's taking time for these ULIPs to become popular. So some of the new ULIPs, because of their low cost structure, are only available online because they have very low no distribution margin. So the entire distribution network of insurance like agents are not popularizing that product because there's limited incentive for them. But my advice to the consumers is that go look at the online sites, whether it's a comparison site or an insurance site, look at the product features.
Do that due diligence, go on to comparative sites and look at the products that suits you. Yeah. All right, so Naveen, it's time for a short break, but of course we're going to go into some specific unit link plans, the low cost ones that people have the option to buy now. But it's time for a short break, but tweet us at Twitter at Policy Bazaar. Policy Bazaar, I'm Arjun Bhagat, and with me is Naveen Kukreja, and we're talking about ULIPs in its new avatar. Naveen, can you run down some of the low-cost ULIPs available online? You were stressing on the fact that a number of them are only available online because they are not being distributed through distributors.
Yeah, primarily because they are very low-cost ULIPs, and it doesn't provide enough incentives for the offline distribution, and hence it's not getting distributed through the offline distribution. There are quite a few online ULIPs available now. Examples are like from HDFC, Bajaj, Aegon, Aviva, Edelweiss. I would suggest that go online, look at these insurers, or better still go to a comparison site like ours and look at all the options which are available to you as a consumer, and then look at different features of the time horizon. Typically they will allow you to invest if you are 18 years or above. Typically the horizon ranges between 5 and 25 years. So choose the horizon very wisely in terms of how long do you want to invest it for, and whether you can afford to pay premiums for that long. Look at the expense ratios or the charges mentioned, and also look at the sum assured. It should be 10 times the premium. If that's the case, then the tax exemption applies, and then you can safely kind of invest in this plan.
You'd also mentioned, and that's a concern a lot of people have, is about the timeline. Finances change, people are not able to continue paying the premium for many years. Sometimes it happens, emergencies come up. What provisions does ULIP have in that sense?
So it's a very good point. So while I'm saying that it should be for long term, like you said, consumers sometimes cannot. So the regulator brought in a condition wherein now, if you have missed if you have missed paying premium, let's say after 2 years, and you can no longer continue to pay for whatever reason, you have financial difficulties, what happens is the insurer has to give you the surrender charges are very low. So the surrender charges from second year onwards are as low as 20% or 3,000 rupees, whichever is lower. And as you kind of invest for more years, the surrender charges continue to go down. After 5 years, there are no surrender charges. But even within the first 5 years, let's say you invested for 2 years and you can't continue any longer, the insurer gives you the option of either reviving the policy within a span of 2 years, right, or if you can't even revive it, they put your funds which you have accumulated so far into a different fund called discontinuance fund. Now that's interesting because that's a different fund. The insurers can only charge a certain amount that's been capped by the regulator, and they invest in a money market instrument which which typically has a growth rate of 7 to 8%, which is like a fixed deposit rate or a gilt rate, so that your funds are lying there for the next 3 years if you've come out after 2 years, and at the end of the 5 years you get the funds that you invested in the discontinuous funds plus the growth that has happened. So all the growth that has happened in that fund, the insurer is supposed to pass back to you as a consumer.
Right. So certain comfort. There's a certain comfort in doing that now, as opposed to earlier.
Yeah, there's a lot of comfort. So in case for any emergency you can't continue for even 5 years, your funds, you will not have a loss. It will go into discontinuous funds, where usually while the insurer has to guarantee 4% return, but usually what we've seen is that the returns so far have been in the range of 7 to 8%, or in some cases even slightly higher.
Right. Well, it's time to take questions from our viewers. We've got Anisha, who's 28 years old, and she had opted for a ULIP, and she's already paid 4 to 5 installments. However, a recent statement showed that the valuation of her investment has gone down tremendously. She does not feel very confident of the returns of investment for the next 10 years. That's the time horizon that she had. She wants to know if she should continue investing in a ULIP, or should she opt for an alternative investment option.
Anisha, unfortunately you haven't mentioned when exactly did you invest, and like we talked about in the show, 2010 is when the new regulations came out. However, from what you've said, it looks like it might be before 2010. What I would suggest is that speak to your insurance provider, understand what are the surrender charges if you have to surrender now. If the surrender charges are significant, and the thumb rule could be if the surrender charges are higher than 20-25% of your fund value, I would suggest do not close the policy right now. What also happens is that in the old plans, the charges were front loaded, which means that in the first few years the charges were typically very high, and in the later years the charges were very low. So now that you've crossed 5 years, the charges would be low. So even if you continue for a few years, till the surrender charges come down, it may not be a bad idea. So I would suggest find out what your surrender charges are, and if they are high, do not surrender now.
Right. We've got Anil Sharma, who's 63 years old and would like to know if it would be appropriate for him to invest in a unit-linked insurance plan. We've been talking about the advantages of ULIPs and how they've really transformed the last year or so.
Yeah, we've been talking about that, but Anil, my advice to you is that ULIP is not the right product for you given your age, because ULIP, like I said, has a sum assured built into that, which means that there'll be mortality charges, and given your age, the mortality charges would be a huge component of the premium you pay. So ULIP is not the right product for you at this age.
Right. So what could he look at?
So from a savings perspective, I would suggest that invest in a fixed income return depending on the horizon. So if he's looking for a regular income plan, then there are income plans from non-insurance, but like a PPF or a postal office deposit or a normal fixed deposit. If he's looking at a longer term horizon, he could go for mutual fund. ULIP not, I'm saying ULIP, not ULIP, because it has a mortality charge.
Right, and we talked about advantages of investing in ULIPs at a younger age. Well, we've got Rishi, who's 30 years old, wants to know if investment in market-linked insurance plans is a good option, given that he's averse to risk. He wants to opt for a plan that would give him a higher return in the future. So a higher return, but averse to risk, kind of a...
Don't go hand in hand, like you said, higher return and averse to risk do not go hand in hand. So risk return is a simple equation. The more risk you take, there's likelihood that in a long term you will get higher return. However, given your age, you're very young, you're 30 years old, I would suggest that go invest in a ULIP. Even if you have a lower risk appetite, you can go for a low risk fund option or a balanced fund option, which invests in a mix of equity and debt. Even if you don't want to take that risk, also go for a debt option, which will give a debt like return, which is 7-8% in the current environment, but do not expect higher returns. However, if your horizon is long, I would suggest go for the equity option. Over a 5-year period, it almost always has outstripped the gains that have secured income.